Okay, guys, so I have to apologize because I had shot this video earlier in the day and we did an entire class on this only to realize I was not recording it. I'm still fairly new to the school platform, so forgive me for that error, but here we are. And I would say this is going to be a refined slide deck now. So here's the topic we're discovering, we're unpacking, I should say. It is the concept of a very specific scenario in which the seller is, dare we say, a boomer. Now, boomer's not fair to say. It could be a Gen Xer, Gen X. But the point here is we are going to be entering a market, and if not, we're already here, where the good old days you used to rent back to the seller. Let's say you're working with a buyer. Buyer wants to purchase a property, and as a favor to the seller, we're going to offer rent back. The issue is, think of the seller's position here. They have not had they've had a long period of time with no mortgage. So I know we like to crack jokes about this, but a lot of these older homeowners, they bought their home for pennies. I mean, they bought it for $300,000 and they have paid off their mortgage 10 times over. They haven't paid for anything. They're literally living off of property tax payments. And now here comes this buyer that says, hey, I'm going to do you a favor. I'm going to let you rent back your own house at my monthly mortgage payment, because a buyer that's worth their salt and their lender is going to say, hey, you need to cover your PITI. And the previous homeowner is going to say, okay, great. How much is that? Well, it's $7,300. That's not helping them. So this is going to be an impasse that we're going to have locked in the chamber a few solutions. And I'm going to be proposing actually quite a few ideas. And I want you to take these and kind of just consider them tools in your toolbox. Not a single one is going to solve all your problems, but to have all these ideas in your back pocket is going to create more value to your buyer and your seller. Because again, in one situation, you may be working with the buyer trying to get the seller to agree. In the other situation, you may be working with the seller trying to get them comfortable with the situation. And then in a really dynamic situation, you might be representing both sides. So here is what we're going to be trying to do is we're trying to overcome the 0 monthly housing expense for the homeowner. Minimal financial pressure to relocate. Yeah, maybe they're dealing with the situation, but they're going to get discouraged if this is what they're looking at, the homeowner. And then they have a lower incentive to vacate at closing. So let's take a look at these things. So number one is we need to think of this as a win-win. And in a situation like this, you need to put yourself in both the buyer's and the seller's shoes, regardless of who you're representing. So for example, if you're the listing agent, you need to think to yourself, how can we make this work for the buyer? Otherwise, I'm not selling my listing. And if you're working with the buyer, you need to be able to put yourself in the seller's position and think, how can we make this worth it for them to get out of the way? So here are the risk profiles, if you will. Exposure to possession delays. There is a chance that the seller cannot find a property to relocate to. And then there's carrying costs. If they have, as soon as they close, they're on the hook for their mortgage payment. And then of course there's timeline disruption. Now seller's constraints is just flat out relocation logistics. Financial recovery. Again, we go back to this perspective of the seller. You have lived mortgage free. You've won in life. You have no mortgage, but something happened and now you have to vacate. You have to get out of this house. Well, welcome back to 2026, where the mortgage payments are probably 5 times what you're used to. And then just in general, if you're talking about a 75, 80-year-old homeowner, this is a stressful transition. So naturally, you are trying to create a win-win in this situation. So let's go through a few of these things. Now, this isn't even an option. I'm going to be honest. You need to do an escrow holdback. You need to do whatever it is. And when you do a residential lease back, you're going to see the option to mail the check, Venmo, PayPal, all these things. Just have escrow hold the money. Save yourself, save your seller the problems, save your buyers the problems, save the logistic issues, especially again, thinking of the profile of this homeowner. They don't know Venmo. They don't want to deal with Venmo. So just as a rule of thumb, be prepared to write in an escrow holdback. And in the future, we'll talk about the verbiage, because something a lot of agents don't do is they say what the holdback amount is, but they do not instruct escrow on when to release these funds. I know this might seem like common sense, but escrow has to play dumb. They have to say, okay, you're having us hold $21,000. We understand that this is for the mortgage or for the rent, but when do you want this released? Okay. And that just protects everybody. Now, we're just going to go through the simple ones. Number one is a flat rate rent back, meaning the buyer purchases the house, their mortgage closes. The escrow closes, their mortgage begins. So what do? They just say to the previous homeowners, the sellers, now the tenants, hey, our PITI is $7,300. We need you to pay us $7,300 per month. So you would go to escrow and tell escrow during the transaction, hey, we're going to give a 60-day rent back. That's right here. And we want you to hold back 60 days worth of rent and maybe a third month for the security deposit. And then, and there's going to be, we'll talk about this in another slide. You need to be able to put in some type of a holdover tenancy where there's a penalty per DM if they overstay, because the loan will start to go south on them. It may be the terms will change. It may switch to an investor loan. So that could go pretty bad. So this one's super simple, but I would argue that the flat rate rent back is kind of the crux of the problem. You're going to have a hard time being a buyer, seeing the seller agree to that. And you're going to have a hard time with a seller going back to such a large mortgage payment, essentially. Okay. Now, option number 3 is a free rent back. If you were around in 2021, people were doing this left and right. Now, here's why this was such a viable option in 2021. Interest rates were 3%, 2.5%. So it wasn't a huge hit for the buyer to basically pay the new mortgage without being in the house. They were willing to say, hey, seller, we got you. We'll pay this 3% mortgage payment for a couple of months. I would argue this isn't really an option anymore, because in a certain scenario, you may have a buyer that is trying to sell their house. And there is a very real scenario where that buyer is willing to sell their house after the fact and essentially take on 2 mortgages for a fixed period of time. So this is not the best option for your buyer. Now, option 4, price adjustment. Now, I know this is recorded, but I'm still going to be careful here. This cannot be written into the contract. But then an option is, and I'm going to use some really, 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 really easy math here. Okay. If the purchase price is $1 million and you want to essentially relocate the sellers, you want to say, hey, look, you're not going to rent back this house. We understand it's too expensive. We're actually going to pay for you to rent somewhere else. So we understand that market rent is about $4,000 per month out in the open. And our PITI is $7,000. So what we'll do is we will give you extra money on the purchase price so that you can pay for your rent out there. Now, the reason why this can't be in the contract is because the lender doesn't want to see that. Lender isn't going to essentially sponsor you to relocate the seller. But what you can do is you need to, I would say the art in this is communicating what these extra funds are meant for, meaning, hey, listing agent and seller, I know the purchase price is $1 million. We also see that monthly mortgage or monthly rent out in the market is $4,000. So our offer price, wink, wink, is going to be $1,008,000. That $8,000 is meant to cover you for 2 months of somewhere else. Now, here's why I recommend 2 months. This isn't based on anything, But what you don't want to do is cause an appraisal issue. I don't know very many appraisers that are going to flag an $8,000 deviation. Meaning, if you were to say, "Hey, we'll cover you for 6 months of rents," well, now you're talking a $24,000 over the list price. You're going to run into an appraisal issue. I think 2 months is a safe number. I don't foresee an appraisal issue. Every market's different, but it's another option. But again, this can't be written into the contract. There has to be an art to this where you're speaking this to the listing agent and their seller. Okay. So I think this is a decent option. Option 5 is a mortgage offset rent back. Now, hear this out. If your buyer has a mortgage that they're currently paying, and it's going to be a lower mortgage, most likely, we're assuming a buyer that's moving up. So let's say this buyer has a mortgage of $4,000 and they're purchasing a new house and the new mortgage is going to be $7,000. There is an option where you can have the seller rent back the house that they're selling and the buyer is purchasing. They can do a rent back that just so happens to be the amount of the first mortgage. So this visual kind of helps here. Buyer's already paying for mortgage number 1. The buyer purchases the property, essentially takes on mortgage number 2. What the seller can do now is the seller rent back can be to offset mortgage number 1. So meaning what you have in this situation is you have a buyer paying for 2 mortgages. The rent back option is to pay or offset one of those 2 mortgages. Yes, the cheaper of the 2 mortgages, but again, there's a win-win here. The buyer only has to take on 1 mortgage now, and the seller is able to rent back at a lower monthly payment instead of the current PITI. Okay. So I think this is actually creative and I think this could work. Number 6 is simply a tiered escalation model, because remember, there's always a risk that the seller doesn't ever leave. And I don't think we would like to think that's going to happen, but a way that you can write this in, again, you'd have to do the math in advance. You'd have to write it in the escrow instructions, and you would have to instruct escrow how much to release and when. But you can say, "Hey, seller, we're going to let you release back at our 50% of our PITI." So again, using the $7,000 number, your first month renting back from us is going to be $3,500. Your second month renting back from us is going to be $7,000 because that's what our mortgage is. And then in this, you're going to be putting notice the verbiage here, a premium daily holdover rent to create strong exit pressure. Now, what does that look like? I would say putting something in place like $500 per day. Now, what does that look like? Well, you're talking about a $15,000 penalty if they don't get out of the way. Now, you may think that that's a little aggressive. Well, this is at day 61. I like to think that knowing that at day 61, they're going to start looking at a much more expensive rate. I think most sellers will just think the better option is to get out of the way. But this gives them some freedom. Because remember, on a win-win, you want the buyer to have control and you at least want the seller to have some control over their exit. And all these ideas are giving the seller some ideas. They can get a little bit more money in their pocket so that they can apply that to a rent. They can decide to offset the buyer's first mortgage as a rent back. They can buy themselves some time before they're facing some significant pressure, meaning 50% here. Okay, so again, using the numbers, $3,500 a month here, $7,000 a month here. And now if you're willing to wait an extra 61 to 90 days, now you're talking about $15,000. So arguably, you're having a 50% increase and then another 50% increase. Okay. Now, here's another idea. And this is in the situation where maybe you have a buyer that has the 2 mortgages. They're going to sell. Most people do not have the option to carry 2 mortgages for very long. So there's a good chance that buyer is going to try to unload their first property. So here's an option that you can do. What is the cost of prepping their house for sale? Because if you really think about it, again, putting yourself in the shoes, The buyer has a mortgage number one. They have now a second mortgage, and there's another third big bill, and that is preparing their home to sell. So here's the question. Buyer will start to get quotes on what it's going to take. Maybe a fresh paint, maybe some flooring, but only cosmetic things, maybe even staging. They're going to figure out what that cost is, and now they're going to have the seller give a credit or escrow holds the funds, however you would want to do it, to offset that cost. Now, again, the seller is able to get out of the way or stay, however you guys want to work that out. But in this situation, maybe the seller is staying on the property for an extra month, but the cost of them staying there is simply the preparation cost for the buyer's listing. Okay. So here is my this is how I'm going to cover my butt here. This is not a one size fits all solution. What I like to think is that throughout all these options, you become the go-to solution. Okay? You think in the back of your mind, you say, well, I actually have a few ideas. And you're running through all these options. Dare I say, maybe you have these written out. Maybe you make this as a PDF that gives your buyer some options of, hey, if we run into a boomer that has no mortgage, here's some ideas of how we can get our offer accepted versus other people's. And if you're getting a listing for an older person, you may say, hey, look, I have an idea. Here's some things that we can do to buy you a little bit extra time, not at the current mortgage rate premium of, $7,000. Now, our price point, Pasadena brokerage might be $1.4 million. So these mortgage payments are huge compared to what these boomers have been paying, or $0. They haven't paid anything for a while. So again, your job is to be the strategist. Your job is to say, hey, I'm not going to tell you which one is the better option. I'm going to point you in the direction of some great ideas, and let's walk through each of these. At the end of this, you're going to be in an advantageous position depending on which one you choose. And of course, it's going to be specific to every single person, timeline, and your job again is to provide the solutions and maybe even the combinations of solutions. So, thank you guys. I'm sorry for the for not recording this the first time, but hopefully this was helpful. I think this is the next frontier. We know that we're going to see the greatest transition of wealth in the next 10 years. And we know that these boomers are going to have some major pains coming their way. And our job is to provide those solutions. So hope this was helpful, and I'll see you guys on our next video. Okay, say bye. Hurry. Say bye.
Let me
Say bye.
bye.
There you go.